We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. Today, my guests are Bill Burckart, who is President and COO of the Investment Integration Project, or TIIP. Bill has been at the forefront of impact investing and has contributed to the field through groundbreaking research. And my other guest is Bob Dannhauser. He's a researcher and consultant on asset management, wealth management, and sustainable investment, and serves as a senior advisor to TIIP. So welcome to the podcast, Bill and Bob.
Thanks.
A pleasure. So before we get started, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview? And I'll let whoever wants to go first.
Yeah, sure. So this is Bill, just jumping in here. I'm the co-founder of the Investment Integration Project, or TIIP. We're an applied research and consulting firm, essentially helping investors invest in a way that builds the resilience of overarching financial, social, and environmental systems that are responsible for long-term wealth generation and prosperity. I've been in the field for a number of years, working as a consultant, working as a researcher, and now as a writer with a book coming out in the spring of next year on 21st century investing.
Great. Bob?
And this is the other Bob. So I'm relatively new to TIIP, or at least in a formal affiliation with TIIP. I just began working with them earlier this year as an advisor after kind of looking over their shoulder for the last couple of years from my perch at CFA Institute, where I was on staff running private wealth management. And the thing that I've always admired about TIIP and has intrigued me and brought me closer to working with them is they really do have a unique take on sustainable investing and how it fits with investor motivations and investor objectives. Something that I've dabbled in for most of my career. And so it's just a real pleasure to be able to work with Bill and his colleagues more closely on these issues now.
Okay. So my understanding is that TIIP, that it's best known for exploring sustainable investing at a systems level. So what exactly do you mean when you talk about systems approach to these issues, and how has it become relevant to financial advisors and their clients? Bill, you want to tackle that one?
Yeah, sure. So when we talk about systems at TIIP, we're really referring to those large social, financial, and environmental systems that are essentially the foundation of our society and really any successful investment. And so at the broadest level, if you think of social systems, you're thinking of things like healthcare, food and water security, fair employment, economic and environmental justice, among other things. For financial systems, what you want to envision is something like fair and honest markets, access to basic services, and transparency of data. And then when you think of global environmental systems, that can include things like climate stability, natural resources, oceans and freshwater, arable land. So these large systems are in turn made up of subsystems, and all are interconnected and ultimately impact one another. And in terms of the work that we do, when we think about system level investing, it's really about this idea that you're shifting your focus from really managing individual securities within a portfolio to really starting to understand and manage the context within which these portfolios exist. And when we say context, we really mean those kind of systems, the things that essentially create the enabling environment for long-term financial performance for investors.
So what kind of reception have you gotten from financial advisors to date?
Yeah, sure. It's I think the sentiment among advisors around ESG and sustainable investing has shifted pretty rapidly just in the last couple of years. From our perch, we still see a kind of a bifurcated population. So there's a certain segment of advisors who look at this as a passing fad and not something that they really have to spend much time or effort in developing facility with. But a growing number of advisors, and perhaps soon to be a majority of advisors, I think are recognizing that sustainable investing is not just a niche or a gimmick, but in fact is something that clients are really interested in. It's a way of connecting more of what they understand in their day-to-day lives to their investment objectives and investment strategies. And, from a really just a bottom line perspective, it's something that increasingly has relevance to investment portfolio performance, demonstrable relevance, as well as relevance to building a sustainable financial advice practice. No shortage of attention to the great transfer of wealth that's going on right now, to a whole new generation of investors and to more female investors as old guys begin to die off. Wives are taking control who heretofore haven't had the voice that they probably should have or definitely should have in controlling wealth management decisions. And those two groups in particular, younger folks and female investors, have indicated through a variety of surveys that they have particular interest in sustainable investing. And so that's really what led to our decision to publish, with the support of the Money Management Institute, the Fundamentals of Sustainable Investment Guide for Financial Advisors. Bill, do you want to talk just a little bit about that?
Yeah. So when we were putting that together, it's funny, the trajectory or the arc of all of this, where a lot of our work has been on this idea of this promotion of this concept of system level investing. And we had actually did a big event with Morningstar this was like early, it was winter of 2018. And we had published this piece, and it was all about how do you measure your kind of progress at a systemic level. And the head of MMI came up to us afterwards and was like, look, this is really interesting. This is where the field's going. That's great. But until we can better meet financial advisors where they are to really show them how sustainable investing and some of these more advanced concepts can really begin to help address or facilitate client retention and recruitment, that until we can get that clear articulation and meet advisors where they are in their process, it's going to be hard for the industry generally to really move to this kind of next level of analysis. And so that was really the impetus for the project. And what we ended up doing was we did a massive scan of what was out there that can essentially help equip investors to really integrate this kind of thinking into their practice. We interviewed a range of financial advisors, some that are independent, some that are affiliated with some of the big wirehouses. We made sure that we had an eye towards kind of the diversity of the types of clients that advisors commonly end up servicing. So anywhere from institutional to mass affluent to ultra high net worth to retail, and really showing how the kind of model or the framework that we developed as part of this really begins to vary as an advisor really starts to serve these different types of clients. And so that was really the impetus of it. And I think in many ways it gels with a lot of the stuff that IWI has been doing, as well as Bob, a lot of the work that you were doing at CFA Institute.
So just for a moment, talk a little bit about the different needs of advisors depending on the focus of their practice. How is ultra high net worth different from high net worth, different from mass affluent?
Yeah, there is some overlap, but there tends to be different points of emphasis depending on which part of the spectrum you're talking about. So I'd say that the ultra high net worth really have the most experience working with sustainable investment products, and in particular have been leaders in impact investing. So tying together the idea that you want to derive a financial return from something as well as achieving a particular societal outcome. And putting that together in an investment proposition. So advisors who have tailored their practices to either create family offices or otherwise focus on the really, really extremely wealthy amongst us probably already have some exposure to this because, as I say, they've been in it. At the lower end of the market in the mass affluent space, a lot of the investor sentiment has tended to mirror where this industry really got started, which is around socially responsible investing and trying to align individual investor values with the values that are ultimately expressed by portfolio decisions. And in some sense, this is kind of an old-fashioned way of looking at sustainable investing. And in fact, I think it's one of the things that holds some advisors back in thinking clearly about these issues. But there's really nothing wrong with it. I mean, if that's what it takes for a client to sleep well at night, to know that their portfolio is not deriving returns from something that makes them personally uncomfortable, it's really hard to argue with that. There's some implementation issues that go with that we can talk about in a bit, but it's a legitimate point of view. High net worth investors, sort of stuck in the middle, are really, I think, moving fast in adapting sustainable investing as part of their overall portfolio strategy, and they're sort of cover the map from strategies that avoid bad actors or bad companies, if you will, and I'm making air quotes around bad, which of course you can't see, but it's an exclusionary strategy that's very typical of the old socially responsible investment strategies. They're also interested in impact investing, like their higher wealth brethren. But they're also, I think, intrigued, and at least the numbers would suggest, increasingly putting their dollars where their beliefs are in asset managers who can integrate environmental, social, and governance, so-called ESG factors, into the portfolio management decision. And there's any number of reasons why they might do that. It can reflect on the quality of companies, the quality of management of companies that are in their portfolio. It might speak to the resilience of companies in their portfolio. The pandemic has certainly, I think, opened a lot of people's eyes to the importance of a business model that's built for the inevitable bumps and chasms in the road, much like we're experiencing now. So in that sort of middle space of high net worth investors, I think you're finding sort of the full expression of demand for sustainable investment strategies.
So in the guide, my understanding is that you address the myths and realities of sustainable investing, whether it's just a fad or whether it hurts performance, whether these kind of factors affect investors or not. And I would also note that the timeliness of the guide in the context of the Labor Department just issuing their statement about ESG investing, I think is certainly worth noting too.
Yeah, that's I guess not too surprising given the overall trajectory of regulatory interest in the Trump administration in sort of backing off some of the more progressive interpretations of fiduciary duty that were launched during the Obama administration. They've really tried to bring things back to focusing on a pretty narrow definition of bottom line returns, and I think that's going to continue to slow down potential growth of assets in defined contribution plans specifically that make a point of integrating environmental, social, and governance factors as a key part of the investment strategy. Certainly not impossible to do, but it's just a higher bar that the government has set forth now with the new DOL regs. You mentioned the myths and realities, and yeah, it's I think one of the services that the guide that TIIP has produced does is it addresses squarely the kinds of misperceptions and biases that financial advisors come to the table with. So these aren't necessarily myths that clients are buying into, but are more a creation of industry where advisors have convinced themselves that this is just a fad. And we talk about that a bit in the guide, but I think one of the most compelling statistics in the U.S. specifically is 60% compound annual growth rate of assets in a 4-year period, 2014 through 2018, bringing the total of sustainably invested assets up to just shy of $12 trillion. I mean, that's real money and a significant commitment of investors by all stripes to these strategies. So something that kind of belies the notion that this is just a fad. Probably the most damaging myth that investment professionals and financial advisors have is that applying ESG considerations to a portfolio strategy inevitably compromises performance. And I think there was more credence to that argument under that old style of exclusionary tactics, where you made a list of bad companies that you didn't like for whatever reason, and you made sure that they never found their way into their portfolio, and you sort of suffered the risk consequences of having an imbalanced portfolio as a result, or missed out on some fairly juicy short-term or medium-term returns as a result of excluding those actors. And the world has changed. There's still the opportunity to do that, but there's more sophisticated risk management techniques, all the way down to individual advisors creating their own indexes customized to account for whatever their client preferences are in terms of exclusions, and then using factor analysis to try to modify the overall portfolio risk and return profile to satisfy a larger, more comprehensive index. There's a couple of more recent studies out that bring empirical heft to the idea that applying ESG factors is at worst neutral and in fact can contribute to outperformance. Again, sort of taking a nod to the idea that ESG is a reflection of quality of underlying portfolio companies. There have been, since the pandemic started, some, I think it's mostly Morningstar stats that have come out that have compared a universe of ESG funds performance, that they've outperformed non-ESG type funds. That's sort of interesting from a trivia standpoint. I don't think anybody's ready to make too much of that. It's a really short time period. It's a really unusual period in the marketplace. But it is gratifying that ESG funds have managed to at least offer hints of resilience relative to other companies that might find their ways into portfolios.
The one thing that I just want to underscore, because it became like a bit of a lightning rod data point when we were developing the guide. And since its release, it's been something that it comes up quite a bit, and particularly with all of the kind of road showing that Bob and I have done on this. Whenever we talk about that, we included in the guide the 12 trillion statistic that essentially one in three or 1 in 4 assets under management are somehow aligned with sustainable investing thinking. And one of the things that we found, particularly when you get outside of New York or San Francisco, is that statistic kind of rings false to a lot of advisors. And oftentimes you can prove that out where you walk into a room of advisors that maybe are just coming around to sustainable investing, and you ask, show of hands, who here in the room had, their book of business is 1/4 focused on sustainable investing. You don't get many hands. And one of the things that we tried to do in the guide, and we've seen it subsequently picked up, is just this. We really draw a focus on the kind of growth by certain segments of your book. And Bob talked about, this growing interest by women and millennials. And you can literally just Google women, millennials, sustainable investing, and there's statistics range anywhere from 84 to 90% of all signal an interest in sustainable investing. But the thing that we like to do is then point to some data that came out of a couple of different shops where they basically show that, essentially 2/3 of adult children and 70% of widows essentially leave their financial advisors after receiving an inheritance or after a spouse's death. And when you give it the kind of hockey stick growth and interest from those particular segments around sustainable investing, it's one of those things that when we say it's sustainable investment is growing and it's good for business, that's where we really like to focus folks, because it's where folks can kind of see the most potential, particularly when they look at their book and they can start to understand the value of how this can be used to kind of create stickier relationships with a lot of their clients. So it's just one of those things that it's always like a very sensitive point that raises a lot of eyebrows whenever we throw certain statistics out. But I think that's probably the one that, if any advisor that's listening in now, that's probably one that I would really direct folks to pay attention to.
And I think Bill and I both presented at the Investments Wealth Institute annual conference experience last year on the guide. And we were very pleasantly surprised, but surprised nonetheless, that it was a full house with a lot of different kinds of advisors. So younger advisors that we sort of assumed would be interested in this, but older advisors who I think are beginning to think about the next generation of clients to sustain their own practices, and hearing and reacting to different priorities and different needs from those investors, and thinking about how they're going to alter their approach to make their own practices as durable as it can be. The other sort of related piece of statistical trivia that I just took note of a couple of days ago, Capgemini just issued their World Wealth Report 2020, which is one of the seminal surveys of the state of wealth management across the world. And they talk about sustainable investing as being a particularly important way for wealth managers to differentiate themselves in a tough environment. One of the interesting things that they reported was that the biggest driver of interest amongst high net worth investors is the potential for higher returns from sustainable investing. And one of the lowest drivers was the idea that they wanted to somehow give back to society. So it's kind of flipping the usual narrative on its head that says, people are attracted to these strategies because it's makes them feel good or helps them sleep well at night, or sort of marries up with their philanthropic urges to do well, however they define well. But they may take a performance penalty by doing so. What Capgemini is reporting is that it's completely the opposite, that most clients think that there is real advantage to investing in companies who are taking what heretofore had been external costs and thinking about how they relate to their own sustainability, and taking that one step further and thinking about investment performance of those companies. And I think that's a really positive step.
Yeah, it's interesting that we're in a day and age where someone like Larry Fink is sort of thrown down the gauntlet, right? And to suggest that this is the wave of the future on the part of the one of the largest institutional money managers in the world, and yet wealth managers seem to be struggling in terms of making sustainable investing part of their practice. I've spoken to Tony David about this, and he has his thoughts about why that's the case. I'm eager to hear why you think that why they're struggling to make it part of their practice.
Well, the timing is difficult in some respects. So in the U.S., at least, we're in a really politically charged, politically divisive period. And I think a lot of advisors that we've talked to are just scared that they're going to blow up a potential relationship or an existing relationship by talking about issues that have a political tinge to them. And they just can't see a way to gently explore the possibility of client interest in sustainable investing strategies without potentially hitting some tripwires that could be pretty devastating. I had one advisor tell me, geez, why don't I soften them up by asking them about their religion first? And he was joking, but I was thinking, religious investors have been the sort of leaders in a lot of these strategies, and so yeah, maybe that's not a bad idea. If your client is Catholic or Methodist or Quaker, those three in particular have taken some really interesting first mover advantages to thinking about sustainable investment strategies. Again, going back to the guide that TIIP put together, we saw this as a really important issue to confront head on. And so we've provided ideas for how, in a very non-threatening, low consequence manner, advisors can use the client discovery process where they're learning about their clients and trying to get as much information as they can to, develop a client risk profile and think about appropriate portfolio strategies given their goals and objectives for their wealth, how they can pick up clues that might be revealed during those conversations to give them confidence that pursuing sustainable investment ideas is not going to somehow offend or create problems for the relationship. So that's one big problem I think advisors confront as they start to think about how to integrate this into their practice. Certainly another is just finding the right solutions. So once you and the client agree that sustainable investing makes sense for their particular point of view and their aspirations for their wealth, looking at the marketplace to try to figure out where the best solutions are is increasingly challenging. Asset managers have responded to growing interest in sustainable investing by bringing just a ton of new products to marketplace in the last year or two. Some of which is quite good and quite interesting, and some of which, frankly, is a creation of a marketing department and not so much the investment folks. And so discerning what's good and what's appropriate from some of the less worthy contenders is difficult. There's been a lot of attention spent on the lack of uniformity amongst indicators and data that support the idea of measuring environmental, social, and governance factors in portfolio companies. No great novel ideas there, other than there's a couple of platforms that are beginning to develop some momentum and some permanence in the landscape. SASB, the Sustainable Accounting Standards Board, is probably one of the foremost examples of that here in the U.S. that have created a number of key performance indicators by industry so that different characteristics for different industries can be emphasized or de-emphasized. And that's finding its way into asset manager vocabulary and perhaps more importantly, asset manager reporting. There is an issue that's yet to be solved well for advisors, particularly those working with mass affluent and sort of the lower end of the high net worth investor space, where you have investors who have very narrow interests and you need to find a cost-effective solution for them to address those interests. So a great example, every time there's a spate of school shootings, people become very sensitive to having gun manufacturers in their portfolios. And yet it's very difficult to find a scalable, cost-effective product that can deal with just that one issue. There's been some progress to that. There's some pretty interesting approaches to doing that. But as these new singular issues rise up in the public consciousness, sometimes it's difficult to find a great solution that addresses it from an investment standpoint. And that can be really frustrating, I think, for client and advisor alike. There's agreement that you want to reflect these issues in your investment portfolio strategy. You might even create an investment thesis around why it's important that you do that. But then you find that it's really hard to do sometimes on a cost-effective basis.
I would also just one thing just to add there. So I think that there's two dimensions that Bob just raised that I think a lot of advisors struggle with as they're trying to build up their practices around this. One of them is the external part, which is how do you engage clients in a meaningful way, take them through the process, and really meet their demand for whatever sustainability progress that they're trying to achieve with their investments. The other side of it is that kind of internal side, which is to say, is the scaffolding even built for advisors to really start to prepare to have these conversations, conduct discovery, make recommendations, and then manage those investments going forward? And one of the things that we kind of came through and when we were doing the research was, we had situations. There was a Barron's advisor conference that I attended, and there was an advisor with one of the big wirehouses that raised their hand and they said, "Oh, this is really interesting, this whole sustainable investing thing. How would I go about learning more?" And one of the panelists points to the back of the room to the kind of, head person at the home office that's been coordinating all this and said, so-and-so is literally right in the back of the room, that you're affiliated with that firm. You have a ton of resources, like you just need to use them. Mm-hmm. But to this advisor's credit, this particular platform, it's come a long way in just even 2 years, but the coherence, the accessibility of a lot of the different resources and types of support, and just knowledge about kind of the products that are available on these platforms, the kind of reporting that's available, what the advisor's role is, and kind of facilitating that information. A lot of that has just been, in many ways, either just kind of a hidden subcontinent or that it's just been a little bit of a black box for most advisors. I mean, outside of these kind of, each of these big firms has these kind of collections of, with the, leaders, advisors that have been building up their practices around this. But that's a small little handful compared to the vast world of thousands and thousands of advisors that are often affiliated with these platforms. And so I think, as much as this is about, okay, how do you begin to actually take clients through this process? It is about just kind of being able to make sense of what your platform, whether you're independent or whether you're affiliated, that making sense of that platform to really start to understand what you can offer a client today versus what you might be able to offer them, a year from now. I mean, the field is, as Bob pointed out, I mean, there's more products coming onto the market every day. It's changing in terms of, the minimums are going down, the levels of customization are going up. I mean, there's all of this stuff that's happening in real time. And so I think for most advisors, they're struggling to get their hands around just, the basics of what they can actually provide before they even get into the position where, to Bob's point, they don't want to have to say, I don't know, or no to a client, particularly when that topic gets raised. And so, I think there's two dimensions to this. And one of the things we do in the guide is to help them, we're going to help you go through that client engagement part, but then we're also going to help you make sense of your platform, the things that you need to be looking for to make sure that you can kind of drive that then into the discussions you have with your clients.
I wonder if you could just for a moment you mentioned the explosion of products, and with that explosion has come the term greenwashing. Are there things that advisors need to know about that term as they think about adding sustainable investing to their practice?
You're 100%. And I think Bob started to get to it with the comments about reporting, and just basically that, it's not just that the amount of products has changed. And when we talk about that growth in the product set, in some cases, this is new product being created. And and that's great. And in many cases, those products are definitely aligning or integrating a lot of kind of leading practices in terms of quantitative and qualitative reporting on the impact that they're achieving. There are also a lot of products that are, that have been sitting on the shelf somewhere else and are just getting rebranded and gussied up, and then they're being rolled out there as sustainable products. And so I think that there's definitely there's that tension right now in terms of like what's credible versus what's not credible. And it goes back to this thing that the good news, there's good news and bad news here. The good news is that there are any number of ways to integrate and measure and report on the sustainability of investments. The bad news is that there are any number of ways to integrate and manage and report on the sustainability of investments. And because there is this kind of wild west in terms of the types of performance indicators and data providers and analysis that are out there, it really becomes incumbent upon the advisor to not necessarily have the answer when it comes to every product, but really kind of relying on the home office, being able to know the kinds of questions that you should be asking across asset classes, across product types, and then really being able to make sense of some of these different data providers and analysis and ratings agencies, so that you can really, some of these folks are scoring things based on a globe, some are on letters, some are on numbers. The indicators that go into these things can go anywhere from 5 to 120, so you have this kind of, it runs the gamut, and so I think it's, for the advisor, it's really trying to get a kind of navigational beacon in place so that they can begin to sort through this, as opposed to necessarily being an expert on every product to know, is it credible or isn't it credible. But it does become, this is just a new area of expertise and skill set that an advisor, in conjunction with their platform, really has to be able to start to make sense of. I don't know if Bob wants to weigh in on that as well.
I think just to point out that TIIP has just published in the last couple of months a sort of high-level guide to due diligence in this space to get at some of the issues that advisors are being confronted with and trying to find the gems amidst all the noise and just a prolific number of products that are available to them. So like the guide that we've been talking about, the due diligence guide is available for download at the TIIP site. That's TIIProject.com, TIIPproject.com. And it's free. It's a public good. So hopefully that might be of use.
And it's free and it's thorough. It's 88 pages long. This is not an insignificant piece of work, I should note.
Yeah, so that's the good news. There's lots of good, meaty content. The bad news is we recognize that advisors are really busy, and the likelihood of any of them sitting down and paging through 88 pages is really, really slim. But a lot of that 88 pages is appendix information that is meant to be sort of useful on a just-in-time basis. So there's a couple of case studies that present some client archetypes that might seem familiar to advisors to help them understand how things might be positioned and responded to. There's a great client facts section, which I think has been one of the most popular parts of the guide. It prepares advisors for the hard questions or the awkward questions that might come from clients, so that they don't feel like they're completely without ammunition or preparation in dealing with client objectives or concerns. So yeah, it is thorough, but you can dip in and out of it pretty easily, I think.
All right. So when I think about podcasts, I always think about there being three sections to it: a discussion about where we are, a discussion about where we've come from, and a discussion about where we're going. So in terms of what's on the horizon for sustainable investing, what is it that wealth managers should be thinking about?
Yeah. So it's a really good question. It's something that obviously keeps us up at night at TIIP. And it's funny, when we first launched and we were trying to elevate the discussion around sustainable investing to really beginning to think about the context or the kind of systemic implications of investments, and really trying to essentially go from just mitigating risks related to certain issues or kind of isolated bespoke products that are attempting to provide solutions to some of these issues. It's really, how do you start to invest in a way that addresses like the fundamentals of these systems, so that these sticky issues don't emerge to begin with, right? And when we started, I remember I would often talk about that if you think of system level investing as an intersection or something, that it wasn't a very crowded intersection, and that in the years since we launched, with various dramatic disruptions like the financial crisis of 2008, you have kind of steady and dramatic degradations from climate change and inequality. All these things are now kind of more front and center for investors. And then this was all before the pandemic hit. And so I think that more and more folks are waking up to the kind of systemic quality of their investments. And in particular, this issue around systemic societal risks, as probably most pivotally dramatized with income inequality, I think is becoming more and more front and center for investors. And so if you think of that as this kind of broad overarching issue that's going to have, it's of the same magnitude as climate change, but as the pandemic has shown, we are feeling the effects of it in very dramatic ways even sooner. And so I think that more and more investors are waking up to, one, that there needs to be this systemic quality, and that two, these sticky, messy societal issues are really going to be kind of the kind of laser focus, particularly in the foreseeable future. And when you start to really poke at these social issues, yes, it's income inequality, but the moment you add an additional lens of racial justice, the moment you add an additional lens of gender, I mean, these things get even more complicated, more complex, and it's changing the expectations and approaches that investors are willing to consider and take, and what they're going to be nudging their advisors to try to help them address. And so I think that is going to continue to be, not only is it becoming more and more front and center now, it's going to continue to be. And I know that's true because the conversations that Bob and I and the rest of the team at TIIP are having with any number of the big platforms, everybody is interested in more and more guidance and information and resources about the kind of why investors should care about these issues, what exactly they should be caring about, and then how do they begin to mobilize investment strategies to solve them. And so I think that that's going to be something that we're going to see more and more and more of, particularly over the next 18 months to 2 years. I think that there's right now, the current administration with the DOL guidance, I think that there's that's a step back, right? Or it's a freeze in the market that until probably a subsequent administration clarifies the guidance further, it's going to have this kind of it's not going to have the most momentum building dimension to all of this. But at the same time, you're seeing a lot of efforts around kind of clarifying what exactly constitutes a sustainable investment. You're seeing that here, you're seeing that in Europe, you're seeing that in Asia. And so I think that there's, for wherever we take steps back, that we're also seeing steps forward in terms of really starting to professionalize and formalize a lot of this work with basic standards. And so I think we're going to see more of that kind of tension of steps forward and steps backwards. But I think generally there's going to be a net movement forward. And then I think there's just the general acknowledgement that we have pointed to this growing interest by women and millennials, that they want these kinds of investments. And, one of the knocks against those statistics, particularly over the last 10 years, is to say, well, yeah, they're interested, but they don't actually control the wealth. Well, that transfer is well underway now. And so I think the more that transfer gets underway, the more that those particular segments that are overwhelmingly predisposed to wanting these kinds of investments, advisors are going to more and more start feeling the pressure to really meet that demand, and to meet that demand in increasingly sophisticated ways. I mean, when we talk to various types of clients, this is not just they're not looking for just like vague risk management. They're not looking for vague alignment with, some overarching global goals. They really want to understand how deep the analysis goes. They want to understand both qualitatively and quantitatively the kinds of progress that's being achieved. And that's going to have major implications for, products that start to get developed and brought onto the market. It's going to have major implications for the baseline level of reporting that all these different shops are going to start to have to provide. and even the level of customization that'll go on top of that. And then, really kind of, I did another event where one of the advisors said, with sustainable and system level investing, it's really helping to put the art back into the art and science of being an advisor. And I think that's true. I think, the more that the fees get constrained and people are looking for ways to kind of demonstrate unique and competitive value, this becomes a really interesting potential leverage point for advisors going forward.
It's just a really interesting inflection point. That everything in the world is pointing towards the importance of these factors. The competitive dynamics of the financial advisory business are such that people are looking for ways to differentiate and be responsive to emerging client segments. So it's just all coming together right now, and the pressure's on advisors to figure out a way to deal with it effectively.
All right. So I guess two things. I always end my podcast by asking if there's anything that we haven't touched upon that we should before we wrap up, or if there's anything that we've already discussed that you'd like to reemphasize.
We've covered a lot of ground. I guess just to welcome listeners to explore the website. There's quite a bit of thought leadership that TIIP has published over the year on these topics. So that website again is TIIPROJECT.com, TIIPproject.com. And Bill and I, once the world returns to normal, are on the circuits and certainly meet with a lot of advisors. But until the world returns to normal, we're both really happy to talk to anyone who might want to chat further about these issues.
Yeah, I think the only thing I would add to that is like I said, we're finally rolling up our sleeves and writing the book on system level investing, and that will come out in the spring of next year. And it's definitely something that we are talking with all sorts of investors, advisors, and industry groups about kind of figuring out the key insights from that work and how that can be driven into practice management. So look forward to, for sure, keeping the conversation going.
Great. Well, Bill, Bob, I really want to thank you for joining us on this podcast and educating our listeners about this topic. It's a fascinating one, and I hope that we get a chance to talk further about it in a future podcast.
Thanks, Bob. Really appreciate it.
Yeah, thanks, Bob.
Thank you for listening to this episode of our special series, Exceptional Advisors in Extraordinary Times. My guests were Bill Burckart and Bob Dannhauser. If you've enjoyed this podcast, then don't miss our Exceptional Advisor webinar series hosted by Tony Davidow, available at investmentsandwealth.org. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. The Institute stands ready to help you as you navigate these turbulent times with new resources, research programs, accommodations for candidates, and certificates. For more details on the resources available, visit www.investmentsandwealth.org. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit us at our website, www.investmentsandwealth.org, to learn more about our certifications, conferences, online learning, and continuing education programs.